Hello and welcome to episode 4 of our fortnightly tax update series, bringing you the latest hot topics from the UK tax world. Even though it's been relatively quiet, I still have some interesting highlights for you. As usual, we'll be looking at general news, HMRC's latest announcements, and 2 cases that have caught my attention from the last 2 weeks. Let's start with general news, and first up is a handy guide from the Institute of Chartered Accountants in England and Wales on R&D admin. You are probably aware that recent years have seen an uptick in the amount of qualitative information that needs to accompany claims. One of these is a claim notification form. This must be submitted no later than the date the claim is made. This advance notice form is distinct and separate from the additional information form. It is largely concerned with the details of the company and the agents involved with the claim. It also requires a summary of the high-level activities, e.g. explaining what the application for the developed solution is. You can view the Institute's post at the URL shown here. Next, the latest approved mileage rates for company cars have been published. These apply from the 1st of June, though employers can opt to use the old rates for up to 1 month. The changes for this quarter are minimal, reflecting a relatively stable period for pump prices. Only 3 of the 9 rates have changed, each being a 1p cut. The rate for electricity has been retained at 7p per mile. HMRC updates are next, and there is yet another one-to-many campaign running. This time, it's taking aim at employers whose accounts suggest there are outstanding loans from directors or employees exceeding £10,000. If a client receives a letter, it doesn't automatically mean they need to worry. Remember that a benefit in kind only arises if there is no interest charged on loaned amounts, or where the interest charge is below the official rate of interest. There are also certain exceptions that can apply. The letters relate to the 2024-25 tax year, so the deadline is the 6th of July. The letter is really a prompt to check the position ahead of this year's P11D filing deadline. You probably know that if your client's turnover exceeds £90,000 in a rolling 12-month period, they must register for VAT. However, you may not be aware that they can ask to be accepted from registration in some circumstances. HMRC has published new guidance about what to do where a business exceeds the registration threshold, but this is due to temporary circumstances. If they can show that the turnover in the next 12 months is unlikely to exceed the deregistration threshold, currently £88,000, they can apply for an exception from registration. The guidance explains that the business should contact the VAT helpline on the number shown here to request Form VAT-1, the registration form, but to say that exceeding the threshold is due to temporary circumstances. HMRC should then send the VAT-1 form along with a form to request an exception. A decision will be made within 40 business days. You can view the guidance at the URL shown here. So what about tax cases? Well, we have 2 crackers for you this week. In this first-tier tribunal hearing, a couple purchased a property in serious need of repair in London for just under £10 million. I know, sounds like a real fixer-upper, doesn't it? Joking aside, the property was completely demolished with a new one built on the same site. The property was purchased in 2010, and the replacement property was completed in 2013. The couple moved in and placed their previous home on the market. However, the London property was sold for £27 million less than a year later. HMRC refused private residence relief, saying the transaction was a trading transaction and should be subject to income tax, as the property had been acquired with the view to sell it at a profit. Alternatively, it said that the property was never occupied with sufficient quality to constitute a main residence, so relief wouldn't apply anyway. The tribunal said there was a clear intention to make the new property the only residence. This was backed up by significant evidence from a number of years, including correspondence with numerous third parties. The couple had turned over a number of properties previously, but this didn't prevent relief from applying to this transaction. Finally, we have a case looking at the gift with reservation rules. The aim of these rules is to prevent individuals from avoiding IHT by making gifts of assets during their lifetime, while continuing to benefit from those assets afterward. A common example is where a house is gifted to an adult child, or a trust, but the donor continues to live in it. The effect of the rules kicking in is to negate the gift as being a potentially exempt transfer until the benefit is lifted. You're probably familiar with the 7-year rule for gifts and IHT. Where a gift is made with reservation, the 7-year clock won't start until the continuing benefit is removed. This may mean the property continues to be a chargeable asset in the death estate beyond the normal 7-year anniversary. There are some exceptions to the rules. The donor can pay a market rent to cancel out the reserved benefit. There is also a specific exception that covers situations where a donor becomes infirm and moves back into a gifted property in order to receive care. In this case, the donor moved back into the property that had been settled into a trust to care for his child, who had significant mental health problems. Unfortunately, the legislation did not provide for an arrangement where the caregiving is in this direction, that is, from parent to child rather than child to parent. In reality, this was the thin end of the wedge. The taxpayer had been receiving a rental income in respect of part of the trust property, and had also used a trust bank account for personal expenses, including paying his self-assessment tax bill. The case is a reminder that separation of legal title and beneficial ownership is crucial to establish in practice, not just on paper. Okay, that's it for episode 4. Thanks for listening, and please feel free to subscribe and share. I'd also like to share a link to our inaugural CPD webinar, which took place at the end of May. I hosted an insightful session covering making tax digital for income tax, and was fortunate enough to welcome bookkeeping superhero Natasha Everard. Do give it a watch, as I'm sure you'll find it interesting. If not, my awkward camera shyness should provide at least a small measure of amusement. Until next time, from me, Andy Rainford, and the team at Tax Essentials for Advisors, it's bye for now.